Good afternoon, all traders, and welcome to the Inside Technicians Weekly Free Support Webinar. This is your opportunity to ask any questions you may have regarding our trading methodology that was designed over 22 years ago now, with regards to how to trade as a real professional. And this is a person who has been in the business for a substantial period of time and is making money every single day within the U.S. marketplace. Before we begin this afternoon, I want to make it clear that everything that we need to do as a profitable trader is to discern between supply and demand who's in control. Because at the end of the day, that's really what we need to quantify. The largest institutions, for anybody who's been trading even a short time, I know very well that these people with the largest pockets are in control and can manipulate, move prices from one level to another. And knowing that, understanding and accepting that, we as smaller players need to identify when and where these people will trade and identify high probability trade setups and nothing less, to be able to take advantage of the possibility of real-time trades that will move in the same direction that these people have already made a decision to go in. This is a key behind longevity in trading. There are many traders who've been around for a long time who will look at the last few days of the 15-minute charts and then look at a 1-minute chart, possibly a tick chart, and they already get in, they already get out, and have no clue about really what is a high probability trade setup. So today's focus is going to be on the Stochastics Momentum Index and the MACD indicator, and how we can use these two different indicators that have really very little correlation between the two, to be able to identify and then get the confirmation to take trade in the moment. This is the key, to take the trade in the moment. Now, we are looking at a trading channel that's been established here between 2091.75 and 2086.75. You are seeing a 15-minute chart of the New York contract month that's being traded now, June 2015. I want you to notice how the volatility has been greatly reduced within this channel because of the overnight session inactivity. Here is the session break as identified by the vertical line, and to the right of it, it's clear to see almost immediately the volatility slows down. The range of the bars becomes much smaller. The highs and the lows are almost, in this case, non-existent. As compared to this. So the price chart pattern, first and foremostly, is something that we need to identify with that has a clear level to the up and the downside, that once broken, because eventually it has to be broken in one direction or the other to trade in what the smart money will decide where to be in. And once again, based on a high probability trade setup. So in this case, the channel is not possibly as thin, as narrow as we'd like it, but it is a valid channel, and getting out of that channel can provide an opportunity to trade and really make money if we have the right type of setup behind it. So looking at the SMI, which is your chief market turning point scout and confirmation, to be able to determine where there's a real opportunity. Right now, we're looking at the last data point, which is a 15-minute bar that ends at 4:15 a.m., and that happened to be on 4:15, that's no confusion, 4:15, April 15th, 2015, at 04:15 hours, okay? That is within the channel itself, the last data point that existed within it. Now, at this point, at this juncture, the Stochastics Momentum Index has already been below the red level here laid out, specific to us, and has turned back around and has crossed from below to above its momentum line, firing a signal to be long. The momentum to the upside has been fairly strong, and the disparity between the stochastics line and the momentum line is fairly wide at this point. So according to this indicator in isolation, we're clear to be long. What we're looking at here is an indicator that has provided a signal which is now clear to be long, however, has some resistance at this point right here. Where prices can have internal resistance, so can an indicator. So in this case, let's fly in a horizontal trend line, and let's place it right at the peak of this data point within this indicator itself. That's really drawn from 130 on 4/15/2015, a few hours before. What we're looking for is for prices to get through the upside, if that's the way it's going to go, and the indicator itself to trade through its internal upside resistance level, just like the prices have a resistance level here in order to be long. Now, the channel that's established on the prices here is clearly, in this case, from here to here, just a little bit higher. So when we look at the possibilities of getting in, we want to get in at a level that is not too close to the dominant upside resistance level. That is the dominant upside, most recently established resistance level, which is really here by this close and this open right here, right at the session break. So let's take this away so we can focus in on the chart. This is where prices really need to get through with a lot of volume in order to push prices to a higher level where a real trade can be taken. Can I get a raise of hands to make sure that everybody's with me so far, that people understand what I'm saying, whether I need to go slower, faster, but everybody's with me? Okay. Thank you. Please lower those hands. So now, where we're looking for the break of the resistance level at 20, 91, and 75 to the upside on the 15-minute chart, and we're looking for the break at the internal resistance level that the previous peak has established on the indicator itself, one of two things are going to happen. It's either going to go or it's not. We'll find resistance as resistance in isolation, and prices will trade back down, and then there'll be an opportunity at a later time, or they'll get through to the upside and things will continue to move in the possibilities of the anticipated direction. And by the way, what we do know for sure that at this time, even if we get up and through 20, 91, 75, excuse me, it is definitely an area where we have room to go to the upside. And where we have to go to the upside for the lack of entering into a lot of new information here is simply that from the open of 2/25/2015 at 17:15 hours, the open price was 2106 and 25. That is this market's all-time open or close price. So there's still room to go to the upside, even though that area that I just mentioned is superior resistance, where it's going to take a lot of volume to get through, more so than what we're talking about on this particular trading session. So using that information and factoring that in to real-time trading is critical, because you need to know how much upside room is there to go that I could get out at on a price profit target on a rally to lock in a profit, right? It's not just knowing where to get in, it's knowing where can you get out. Where's the roadmap that can show me, can prove to me that this is exactly how much distance there is to go, and if I get the volume that I need, can I get out at that level on a rally in order to lock in a real profit? I mean, we're doing all this to make money at the end of it all, right? For as much work as it really is, it needs to produce something. That something, it has to be money, because this is our living. So let's take it seriously. Let's look at the charts. And now that we have established, because of everything we've talked about so far, looking at the stochastic momentum index in isolation, right? Let's take a look at what some of those levels can be to the upside. We know what the daily level is from the previous all-time high, but what are the prices telling us from the most recent past about really where we can look to get out at on a rally? So as we move back in time above 2091.75, right? Let's see what we have to the upside. We have something very close here, just a few ticks above, or we have something that goes back to possibly here or here. So let's go back and let's take a look. Let's take a hard look at what those levels can be and how to choose them. A horizontal line, all charts, so it shows up on the MACD that we're going to talk about shortly. Okay. What I do know is that I have something right here, and it coincides with this price and this price. Okay. So if I'm going to be in, I should consider being in right here by a tick above it. The original 2091.75 plus a tick would actually be 2092, under the pretense that prices would either follow through or they would not. And if they didn't, I'd be out with a strict half of a point loss as soon as I was shown that by the prices. So here we are with prices, okay, and the open price is at 4:15, AM on 4:14, oddly enough, 2092.50. We get above this, now our next price profit target to the upside is all the way up here. And here's the key. Prices move in levels that have been previously established by these smart money people. And this is really the next level to the upside, because the most recent prices broadcasted out into the future are where the prices will go to first, because they are the most recent past. Again, the most recent past prices broadcasted out into the future, as long as there is a free and clear way to get there with little resistance to the upside, because of the way the chart pattern has been established, will be the price profit target if prices will get up to and through the anticipated preferred entry in order to trade long. Now, the key to this entire trading scenario revolves around enough volume. We need enough volume, the right type of volume, the smart money volume, to get up to and through the ultimate preferred entry on a 1-minute chart in order to follow through, to get to the targets. Without substantial volume, the odds are greatly reduced that we will be able to get to a target. Can I get a raise of hands of everyone who understands what I have explained so far? Okay, we have a new person. One new person that's come in shortly ago, Nicholas. Okay, so here's a target, and if we had to lay out one more to the upside, okay, it could be as far as here. Okay, so let's go back and let's take a look at the most recent action. Here's the trading channel that's been established, and we need to get out of it one way or the other, and the setup is to the upside. And now what we're looking for is to get the move to and through the upside, to get to one of these two targets here for the longer term move. Here's the internal resistance established by the SMI. Volatility is very low. Nice trading channel established between these two levels here, and we're looking for the indicator to trade through its internal resistance level as well as the prices in tandem for the signal in isolation to take the trade to the long side. There it is. And it happened between 4:15 and 4:30 a.m. just this morning. That's just between 4:15 with this 15-minute bar ending at 4:30 a.m. There you are. You're in here, out, and with the possibility of getting a second chance if you got in late, a retracement back down to almost the 50% rule, and price is trading up again to the higher target here. Now, the key when we're looking at the 15-minute short levels in this case is understanding that the 15-minute levels are the approximated level for the 1-minute chart. The ceiling was broken, the resistance level was broken, the target was hit in a very short period of time, and as you look at the 15-minute chart, it doesn't really appear to be a big move. But in real time, getting above this level and getting all the way to here, even trading a small amount of contracts is more than enough money than any trader, I won't say any, but most traders could possibly need on a single trading session. Now, I see some people in this room today who have studied with me personally, and they have a lot of water under the bridge. Gold, commodities across the board, oil, right? E-mini futures now, because it is the ideal market to trade. And they know that staying on the sidelines and waiting for the trade to come to you is the most important thing, because it's proven time and time again. What happens in between the trading channel here is nothing more than a lot of program trading here, as you can obviously see. Things lighten up here, and then the turnaround is made after all the stops taken out here by the bars at this location, taking out all the stops that are located below this portion of the channel here. Okay, turning it back around, confirmation is good to go. So as we look at the overall picture, the signal that was given here to trade long was 100% valid in isolation. Now combined with one other indicator within this methodology, once again, that was designed by myself with a substantial amount of money spent in back testing well over 23 years ago, is the MACD indicator. Why? Because we need to establish the fact, the absolute fact that the trend has changed from one direction to another. And in this case, as we look at the exact same channel, right, with the levels laid out to the upside, it's clear that even at, as we go back to 4:15, again, where this 15-minute bar ends between 4 and 15 ending, that price is still contained within it, but as we blow this up, the MACD had already crossed from below to above, right here. So in isolation, the MACD was cleared to be long because it had clearly indicated that the trend had changed from that neutral to long. That doesn't happen easily enough. It takes a lot for this indicator to fire in isolation. Now what we're looking for is the prices to move up in the anticipated direction, but it has to be with a lot of volume. And as that happens, the disparity will need and should give us, right, the confirmation that we need, because the momentum is increasing to the upside in order to take that trade to the long side. And as that happens and we get through the ceiling at the 2091.75 area, the disparity widens to prove out in isolation that the strength of the trend to the upside, after being confirmed, is growing significantly. This is the key. This is the key. Give me just 1 second, please. Okay. And obviously the disparity continues to widen as prices move up, and then again to here at that level, and obviously later on to another higher level. But this is our concern. It's basically from here to here for the trading opportunity, and possibly from here to here. The best trades that are made based on this type of trading will always be the first trade after the channel is broken. The first trade, the first opportunity. Why? Because this is where the explosive portion of the move should, and the majority of the time, does happen. And what does that mean to you? It means that that's where you're going to make the largest amount of money in the shortest period of time. And that's what we want. We want that because the longer the time horizon of the trade, the longer it exists, it is sustained in real time, the higher the risk becomes because of the extended time horizon of the trade. Because every minute that goes by, every 5 minutes, every 7 minutes, every 8 minutes, every 10 minutes, the smart money can make a decision to create a short-term shakeout to the downside with an existing uptrend. So we need to go with what is known. And what we do know is that we have a clear area to be in and a clear target level to be out at the upside. So now that we know all this, and we know that the clear resistance level is 2091.75 on a 15-minute chart, the question becomes, what is the absolute level to be in? This trade, taken by a lot of people who've been through the system here this morning, just this morning, ironically enough, this is good for us, is what's that level on the 1-minute chart? So let's get to that and let's take a look at that. Remember this, people, it's 2091.75. That's 2091.75. I'll get that on fourth screen. And let's take a look at the 1-minute chart. Okay. The previous level again was 2091.75, and I have a level here that I have laid out as 2092 for resistance on a 1-minute chart. The prices have to get through. Now I do understand that there's resistance here. You know, a channel that has been squeezed down, you know, to a lower area where there may have been an earlier opportunity, right? I would say from here to here, but there was some resistance right here. Some resistance right here. We have no free and clear from this point to this point. So the other consideration into the pictures that did all the 15-minute indicators within this methodology fire at this point? And the answer is no. So essentially, the 15-minute charts with the indicators in the subgraph below were very, very close to firing right here, but did not fire, and enough volume come in to drive the prices through this level to get to a predetermined target to the upside until 426. Okay, 426. And that's when the final indicator fired according to this methodology. Because what we don't want to do is we don't want to get in and get shaken out. We want to make sure that we're on the right side of the longer term smart money players, and that can only be identified by the volume. What got through the initial ceiling here at this point? As we look at the volume that came in, okay, was 1,449 contracts. Now, at that time in the morning, that volume was almost unheard of. So this was a clear signal that prices could continue to move up and get through the 2092 area resistance level. The very next bar, we go from 1449, okay, to 1,062. But now we have two different major volume spikes that dwarf anything that was within the channel previously. And the accumulated volume is tested the resistance level that I have laid out, 2092. So the preferred entry in this case on this particular trade should have been 20.92 and 25 on a closing price to get above, through, and to price profit target. Now, you may not always get a preferred entry that is filled at, per se, the 20.92.25 level. However, one could obviously set a limit order. And as soon as that price is hit, you're filled and guaranteed that if the trade follows through, you're going to take that trade and you're going to ride it up until the price profit target. This is the key. This is what we want. So here we are looking at the level that's been tested but not followed through. And on the very next bar, there you have it. There's your fill right at 20.92 and 25, and prices have moved all the way up to a high within 1 minute's time at the 20.95. Now 20.92 from 20.95, if I'm calculating this correctly, $20.95. Well, that's a lot of points, people, isn't it? You bet it is. In 1 minute's time. So the idea, turned to practice, needs to be that we will take only the best of the best trades and wait for them to come to us. Does everybody understand, please, another raise of hands, everything that I have explained so far? Okay, excellent. Thank you. Could you lower those hands, please? So 2.75 points, or possibly 2.5 points, where $50 is the value of every full point move. It's 2.75 times $50, right? Is a gain of $137.50 on every contract. Let's talk about the money. $137.50 times every contract that's traded. If you only traded 5 contracts, right, that's a $687.50 gain in a very short period of time. All you'd have to do is the math and increase the contract sizing and see how the profit on the trade increases. One of the major benefits behind this methodology is that the majority of the time when prices break through significant ceiling or floor levels, in this case the ceiling level located at 20.92, with this type of volume, with these types of confirmations out of the SMI and the MACD, the likelihood of prices turning right back around is almost non-existent because of the contract sizing that comes in and because of the confirmations of the indicators. Now, this is only 2 indicators within this proven trading methodology. I mean, there is over, who knows now, there's got to be at least 110 real-time trades that have been recorded. You know, that's undeniable truth on the YouTube channel, where people can actually see, you know, moves that were identified by this methodology and taken, you know. So it behooves me to believe why anybody would possibly trade any other way. And the reason why it does for me is because there's times to be trading and there's times not to be trading. There's times to be doing something else, like exercise, like a personal life, like things that are positive in life, and not get glued to trading. Because when a trader does that, the majority of the time, most of the time, you know, they'll have a serious drawdown. And for those of you who are new to trading, a drawdown is the amount of money that's lost before money is made again. So this methodology is going to prevent drawdowns, keep them to a minimum because of everything that's required in order to take a trade, right? So selective. But obviously providing on many days a minimum of 2, if not 3 opportunities. Other days, you're on the sideline, right? So there's the way to get into a business, trade for a living, and stay in the business that other methodologies, they just cannot provide. The guys, the women who, even they have a lot of water under the bridge, that are in there looking to pick up a point, hacking themselves up, it's not worth the stretch, because one person trying to quantify that much information, that high frequency of information for a long period of time, leads to blowout, if not a serious drawdown. So this methodology was designed for many ways, for many facets of trading, to address the issues of what real traders face in order to not just, trade and make money. Anybody who's been around for a long time can make some money, but to make a substantial amount of money and keep doing it, because that's what we want to do, right? That's what we want to do. So last but not least, even if you didn't get this because you were new to trading, right, and got in at the preferred entry at 20.92 and 25, right? And as you look at the 15-minute chart, right, and you know that your levels were laid out, getting back to the SMI 1 second. Okay. Here, which is essentially would have been 20.94 and 75 rounded down, right? Because of the previous area that I had established here on the prices, right? 20.94 and 75. Get out on a rally. Right here, the first one. There you have it. Even if you didn't get this on the initial move, which is what we talked about earlier, the best possible play for the trade, okay, you could have got back in 20.94.75 back to the 1-minute chart. And we'll fly in 20.94 and 75. Target now identified on the 1-minute chart here. Okay. Even if you didn't get this, you could have got back in, or in again, or in for the very first time at the 50% retracement rule based on the large bar up, which is a technique that we teach here. So the initial move, if not taken, could have been taken advantage of again. The only problem here is that the volume dries up and there's no guarantee that prices will continue to move to the upside. The increase in volume didn't come in until here, which was really way past the pivot point low that had been established here. The middle bar of the pivot point low on the close of 434.04, hours, again, today in 415, right, at that price, okay, had no volume, associated volume above the 21 period average volume in order to push these prices up. So again, no guarantees. If this volume had been associated with this pivot point here, right, in and around this 3-bar area, especially here or to the right side on an up close at 435, well, that would have been a clear indication that, as long as all things being equal, the methodology on the 15-minute charts were were indications to remain long, you would have taken that position, would have taken that trade, excuse me, and wrote it up to the initial target that was established here. So there's been a lot of hard-earned trading intelligence that's been delivered over today, and it's always my pleasure to do it. The personal goal of myself and the Inside Technician is to empower you to become a more profitable trader. So we always want to talk about things. We always want to demonstrate techniques that have real-life application, something that we can take and walk with and use almost immediately to become a more profitable trader. It is now 5:09, and we're going to end this webinar now. For any of you who may be viewing this recording, it is specifically designed to support the people who come through the educational system here. For anyone who purchases a course or comes through the Executive Mentorship Program, a way to ask questions in what we call the Traders Alliance weekly free support webinar, so that you don't just buy a course or study here and then you're left behind. That's what everybody else is doing. Continuing education, right? Getting your questions answered, we believe, I personally believe, is one of the most important things that any service should do, all right, in order to separate themselves from everyone else. So before I go for more information about any of what we can offer you here, you can visit our site at theinsidetechnician.com. Look at us on YouTube under myself, Jeff Killian, or The Inside Technician. And we have a wealth of information available at your fingertips to help you, empower you to become a professional trader. It's my pleasure to present to the world today. We have people from all over it. Now 5:11 p.m., finishing it up, and we'll see you next week on the next customer support webinar. Good night, everyone.